All right, hello and welcome everybody to today's webinar. Today's topic, we are going to be talking about 5 creative ways to buy a home without a traditional mortgage. So we're going to be talking a little bit more about non-qualified mortgage products, non-QM products. So this is going to be outside of your traditional, conventional Fannie Mae, Freddie Mac guidelines. So this is going to be for people who might have potentially a little bit more of a unique buying situation. Maybe somebody who's potentially a business owner who writes off a lot of their income, um, somebody who's potentially commission based and doesn't have a lot of steady income, or potentially a retiree who has pension but wants to take out some equity out of their property or purchase another property, buy up, buy down. This will be for those people who don't fit into traditional buying guidelines. So a little bit of what we're going to cover today. We'll be talking about the traditional route, how the traditional process usually works, and then we're going to talk a little bit about the overview for creative financing. We'll get a little bit deeper into it with 5 creative ways to buy a home, as well as what to expect and to prepare. And then if you have any questions at the end, I will be more than happy to address those as they come up. A little bit about who we are. My name is Akeen Brooks. I work with Empire Financial here in Orlando, Florida. My realtor partner is Kimberly Miller. If you're looking for anybody in the Central Florida area to purchase a home through, she is a great resource to have, and I would definitely recommend reaching out to her. So real quick, I just want to take a quick gauge of the room, see how everybody's thinking. What is holding you back from purchasing right now? Is there anything that's on, front of mind that you really think you need to kind of overcome to be able to purchase property? These are things that we'll be addressing more towards the end. I just want to get a quick, brief, little view of how everybody's thinking right now. If you could just put that in the chat for me, please. Cool, cool, cool. Give you a few more minutes. All right, we are gonna wrap that up in a second. All right, so here's how the traditional process is usually working. Let me move myself out of the way real quick. So how it usually works is you're gonna hire a realtor that you trust. You're gonna get pre-approved with a lender that you also trust. You're gonna go tour some homes. You're gonna then make an offer on the home that you fall in love with and that you can afford. You're gonna go under contract once that offer is accepted. You'll complete all your inspections and appraisals of that property to make sure everything is good and you're getting into a properly good home that's gonna last you a long time. You're gonna finalize the loan. Well, I'm going to finalize the loan, and then you're gonna close. And that is basically how the process works for most people. Again, most people, being about 75 to 78% of the market on average, are going to purchase homes through these traditional means, conventional loans, FHA or VA products. Um, like we said, that doesn't always necessarily work for everybody. Unfortunately, we do have some unique buying situations. Like I said, some people aren't able to verify their income on a regular basis. Say, think people who are in a commission only. You have a good month, you have your bad months. Banks like to see very steady income for those kinds of things, for mortgages especially. So those kinds of borrowers usually have a tougher time qualifying for something. Also, think maybe potentially a business owner, somebody who writes off a good portion of their income for tax purposes. They don't have a lot of money on paper, so they're gonna need to apply for something a little bit more creatively. They'll have a little bit of a tougher time. So, like I said, about usually 15 to 20, 25% of home purchases will be done with non-qualifying mortgage products, non-QM, or creative means. So real quick, what is creative financing? So, like I've been kind of alluding to, creative financing is alternative ways to qualify for a mortgage, usually when traditional documentation or credit guidelines don't really paint the full picture of who you are as an individual. Um, so again, the examples I keep going back to because they're just top of mind, business owners, a lot of expenses being written off, not a lot of provable income, but obviously can afford a mortgage payment. People who get a pension, retirees, people who don't have, those kinds of situations that the banks typically don't like to lend on a lot of the times because it's, in their eyes, maybe a little bit riskier. These are the programs that might help those kinds of individuals. So they are legitimate lender approved programs. These aren't this isn't snake oil. This isn't the wild, wild west anymore, especially after, 2008, 2009, things have gotten a lot more strict as far as how these programs are structured. So there are legitimate ways to do this, and we're going to get into that right now. So the first of the 5 creative ways to buy a home that we're going to talk about today is going to be bank statement loans. So this will apply a lot of the times for those people who have good money in the bank. They have verifiable cash on hand, but they might not necessarily have a lot of cash coming in on a monthly basis. We can use what's called a bank statement loan to qualify them to purchase a home. So how it works is we would just need 12 to 24 months of deposits, depending on the lender that you're using. And what would happen essentially is once we get those 12 to 24 months of deposits, they would take a percentage of that number, the amount that you have on hand right now. Say you have, for easy math sake, $100,000 in the bank. You would get all your statements together. We would send that in, take that $100,000, multiply it by, I think, about 60 to 80%, again, depending on the lender. And then that number that it pops out is what we would use as your qualifying income. So it would essentially boil down to, again, if I have $100,000, you got about $60,000 to $80,000 coming in every year is what it's going to look like on the bank statement loan. Again, this is going to be designed for people who are self-employed or 1099 earners, commission-based a lot of the times, individuals. It is a pretty highly flexible program in that regard because, again, it's going off of the aggregate of what you have in the bank as opposed to what you're making every single month. So if you're sitting on a pile of cash, this might be it might be a good way for you to get into a mortgage in that respect. Obviously, the caveat being because the terms are more flexible, that is going to come at a premium in the sense of a slightly higher rate. But do not fret. You can refinance that into a lower rate or a different product, even actually, if you really wanted to, after the allotted seasoning period, which is basically the amount of time that the lender is going to require that you use the property as a primary residence before you can refinance into something else. It's usually about 6 months, 6 months to a year in most cases. Really good for owner occupied or investment purchases. Again, it's just going to depend on you, your own situation, and what you're trying to do. Next one we're going to talk about is DSCR loans. DSCR is an acronym. It stands for Debt Service Coverage Ratio. This is basically a loan product that is qualifying the purchase of it based off of the cash flow on the property, not your own personal income. So, for example, this is going to be mostly used for, pretty much only, actually, I should say, and used for investment properties, rentals specifically. What's going to happen is you are going to find a property that you want to rent out. Say the rent is going to be, I don't know, $1,200 a month. Again, try to keep it simple. Or I should go the other way around, actually. Say the mortgage on that property is going to be about $1,000. To qualify for the loan for that property, you need to be able to rent that property for more than or equal to 1.2 times that mortgage payment. So again, if you have $1,000 mortgage, $1,200 in rent is what you need to reasonably be able to rent it out for. And that ratio can change. I have seen it go a little bit lower, some even to, I think, 0.9 in some cases. So it doesn't even have to fully cover it. As long as rent mostly covers the mortgage payment, you can qualify for a DSCR loan with some lenders. I do want to caveat that a lot of people do have the question on whether that property needs to be currently rented at the time of application, and no, it does not. It can be conjecture. It can be an estimate, or not estimate, but it doesn't have to have a tenant currently in the property at the time of you wanting to purchase it. You can get all that stuff sorted out later, as long as the rents in that area and what you're going to charge can match or cover the debt service ratio. This kind of loan product, I'm sorry, excuse me. This kind of loan product does not require a tax return, so it does allow you to close pretty quickly. Again, it is an investment property, and it's only going off of the cash flow, obviously, and your credit as well, but very, very fast because we know time is money. Next one that we're going to talk about is asset-based loans. It is very similar to a bank statement loan in that it takes a lump sum amount and then gets a percentage of that to use as your qualifying income. In this instance, instead of only going off of your bank statement, we're going off of basically anything that is considered an asset. So we're talking about businesses, we're talking about investment accounts, we're talking about fine jewelry even, anything that can be used as an asset, counted as an asset and used to be made liquid in a reasonable amount of time can qualify towards your qualifying income in an asset-based loan. So for example, if you have a retirement account with $500,000 in it, you can use about $4,166 of qualifying income. Next one here is a little nugget. It's not really a loan product per se that can be offered or sold. It's a more of a technique, really, that you can use creatively to get yourself into housing. It's what's called house hacking. I'm sure it's a term a lot of people who are even beginner investors might be familiar with. Essentially, what you would do is you would ideally buy a multi-unit property, live in one unit, and rent out the others. So, say for example, you buy a duplex, triplex, or quadplex. Live in one unit, rent out the two, three, or four other ones, or two or three or one other unit. Um, Essentially, to help cover your own or offset your own living expenses. Um, Keep in mind, this does not actually need to only be applied to multifamily properties. You can theoretically house hack a single family as well if you were in a position to do so. You can just live in one room and then rent out the other rooms. And then you would have to share a space with another individual, but this is a good way to turn yourself into both a tenant or a homeowner, I should say, as well as an investor at the same time. You're going to be responsible for tenants, but your own living expenses are subsidized, or even potentially flipping a profit to live in your own home and get all that equity and appreciation. And to keep things even more sweet and cash flowing even nicer, you can qualify FHA loans on some duplexes. Obviously, that is going to depend on which properties you're looking at, but it is possible to get an FHA loan for a multifamily property. Again, this is going to be mostly used for first-time buyers, first-time investors, or people just wanting to really, really like maximize their earning potential on their property. And then last but not least, again, not something that I can particularly offer, but it is going to probably be your best bet for finding a really good deal, especially one that can get you a lot of equity, is going to be seller or builder financing. I'm going to put more emphasis on the seller financing over the builder financing if you're trying to build equity or find a deal. That being said, seller financing is going to be a lot more difficult to find of the two. So what I'm talking about here is basically you find a house for sale by owner. That particular owner does not need cash. He's okay with financing it for you. He can take, X amount percentage for this long of a term, so on and so forth. He is the bank. He is giving you your mortgage because, or he or she, I should say, is able to, finance this house for you. Basically, not take the lump sum of the house or the lump sum price of the house, but take it in installments over time. A lot more difficult to find, especially as the economy, kind of does what it does. Most people just want their money and they want to be just done with it, over it. I don't want to have to deal with it. I don't want to have to chase you down for your payments, yada, yada, yada. If you can find a deal where the seller is willing to do something like this for you, this is probably going to be your best bet to get a really, really unrealistically low interest rate that's not, snake oil, if that makes any sense. It's going to probably be your best bet to find an actually good property or an actually good deal on a property, I should say. I can't really promise the property is going to be that good. Um, yeah, not something that I can offer, but if you can find it, that's going to be a really good route to go potentially. It's going to be the most flexible terms with the least caveats. Next one is going to be builder incentives or builder financing. Basically, you find a brand new construction. The person who built it is able to float you the money for the purchase of the property, with obviously at a premium rate, yada yada yada, and all their incentives. Um, that can also potentially be a very good way to go. I would, however, caveat that and say that if it seems too good to be true, a lot of the times it is. And any quote that I get from a builder, as far as their financing is concerned, I would recommend getting a second opinion from another loan officer, somebody that you trust that works in the mortgage field or real estate field, just because there can be some trickery with the math when they do offer those insane incentives, if they're offering you $20,000 down or towards your down payment, that's all well and good. But if the price of the house inexplicably went up 10, 15 grand, suddenly that's not so much of a deal, is it? It's cool if they're going to give you a bunch of money towards your closing costs, but if you end up paying more in interest on that than you needed to, then that might not necessarily be the best route for you. So, not to say that all builders are evil or bad or anything, and I'm not going to name any names either, but if you get a deal from a builder that seems way too good to be true, it very possibly is, and always, always, always get a second opinion. Just because when you get a second opinion, you could also potentially get a better deal. Maybe we can beat it. Who knows? If we can't, then we'll just tell you got a great deal. Go for it. Run for the hills. Um, and these are going to be good for builders or for buyers who need flexibility or short on upfront funds in both cases, because you can negotiate those kinds of things with those kinds of people. Sellers, of course, are going to understand the pains of a buyer, and they can, maybe not necessarily need a massive down payment or need, all this money up front. As well as a builder, they're a massive builder. They have in-house financing, they have money to spend, so they can definitely work with you on those kinds of things because they want to get their property sold. So these are both good options. If you can find one that works for you, um, definitely don't be afraid to take that. What to expect and how to prepare. So even with creative options, the DSCR, the bank statement, um, asset statement loans, there's still an approval process. Just because it's more flexible doesn't mean that it's completely no rules or anything like that. There is still an approval process. There is still documentation, just different documentation, not the same documentation, and maybe not as much, but it's still there. Every lender is going to have to verify that you can reasonably and responsibly manage the payment that we're giving you. Again, because of 2008, 2009, we're not going to just go handing out money willy-nilly. We need to know and verify that you can pay for the money that we're giving you. Um, it's just how they verify that, or what they need to verify that to feel comfortable giving you the loan, is going to vary depending on the loan and depending on the lender. Um, but in any case, at any rate, preparation is going to be the biggest key. It's preparation is power. The earlier that you organize, the smoother things are going to be. The earlier that you talk to your trusted loan professional, your real estate professional, the more you talk to these people, and the earlier on you do it in your process, the smoother things are going to be when you're actually ready to pull the trigger. So which option surprised you the most tonight? Do we have any questions? We have kind of reached that section of the night. Let me make sure. Yeah, we have reached the Q&A section. So anything that surprised you, anything that you're shocked by, if you have any questions, anything that you want to talk about, please feel free to put that down in the chat, and I will be happy to answer those. Unfortunately, I don't think I can pull up the chat here. No, I can't, but it's fine. I will take a look at it and I will convey the message. So I'll just give you guys a few minutes to jot down your ideas. Let's see here. I'll just go through some of the easier ones I see right here. I see what's the minimum down payment for a DSCR loan? Okay, so because a DSCR loan, like I discussed earlier, is pretty much an investment only loan, you are going to be looking at a slightly higher down payment for those loans. Typically 15 to 20 is the average, 20%, or higher is going to be what you're going to want to put down on a DSCR loan. That's what is usually asked for. So think your typical 20%, it's kind of hard to get out of or around that, unfortunately, as far as the down payment is concerned. But again, the your income specifically is not a consideration when applying for a DSCR loan. It's the income that the property can produce. So if you have that 20% down, if you can get that 20% down, that's really your biggest barrier to entry as far as that's concerned. Um, can you use a creative loan for a short-term rental? Can you use creative loans for short-term rental? So we're talking about like an Airbnb, basically, like that kind of situation. Um, yeah, I'm not sure actually. I'm not 100% on that. I'm not completely positive. I want to say yes. I want to say you can use creative financing for short-term rentals like Airbnbs. It would just depend on the lender and the products that they have, but I don't see why not. I'm not 100% on that though. Let me get back to you on that and keep a look on my socials for that answer. Do these loans have prepayment penalties? Yes, yes they do. In short, pretty much, yeah. Most of them are, again, because these are loan products that deal with a little bit more flexibility in the sense that they're not qualifying you on those traditional qualifying factors. They are going to want to see you in that property or in that loan for a certain amount of time before you pay it off. Obviously, it's a lending institution. They don't lend out money out of the kindness of their hearts as much as you might want to believe. They are doing it for a profit. So if they just give that money to you, they stick out their necks as for in quotations. They risk their position, or their cash, I should say, giving you a loan based off of things that other traditional lending institutions wouldn't lend to you based off of. Um, they're gonna want to make sure that they're compensated appropriately for having taken on that level of risk, if that makes sense. Like you in the eyes of the lender are a riskier person to lend to, so they will want a certain amount of money for that risk, if that makes sense. If they're just going to risk it all on somebody and they just pay it off in 2 months, they haven't made any money, but they've taken on all the risk. So yeah, there will be prepayment penalties on most of these loans. The amount and the severity of them is going to depend on the product and on the lender as well. So, but good question. Yes, there are prepayment penalties most of the time on these more creative financing options. And I will find out about the use of creative financing on short-term rentals as well. So keep an eye on my socials for that answer. Um, doesn't look like we have any other pressing questions. So if that is everything, then I don't know why I'm so gassy tonight. I will go ahead and wrap this up for you guys tonight. This is going to be the best contact information for again myself as well as my realtor partner Kimberly. If you are in the Central Florida area and you need a good realtor to talk to or just want to go have a conversation about your local market, she is a good resource to have in your corner, and I would highly recommend at least starting the conversation. If you're ready to pull the trigger and you want to know how much you're qualifying for, those are going to be my best contact information right there on the left. That QR code will take you to all my socials as well as everywhere else that you can kind of reach me. It's Facebook, Instagram, LinkedIn, TikTok, et cetera, et cetera, et cetera. There's a couple more that I can't remember off the top of my head, but yeah, that is going to be everything for tonight. I appreciate everybody stopping by and hanging out for a little while. Hopefully, you learned something. Hopefully, this was of value to you. If you need a refresher, this will be up on the YouTubes as well, so make sure you keep an eye out for that. And yeah, I hope everybody has a great night. Happy Thanksgiving, and have a great rest of your day. Take it easy. Bye.